What's up, everyone? So in this video, I'm going to go over some of the data that's pretty scary, that's actually pointing towards a potential recession. So if you think your portfolio looks bad right now, it could look like this guy over here in the next few days, because it's pretty ugly out there right now. So will we have a recession? Of course, there's nothing 100%, but what we can do is we can look at some of the data, some of the risk that's currently in the market, and maybe come up with some clues if we have a high or low probability of a recession. So let's go over some of the market risks, right? So currently, there's an energy crisis. The oil price is definitely very high. So you're not only getting screwed on your stocks, but you're also getting screwed in the oil price at the pump. So that's really not good. The commodity price are going crazy. Everything is increasing. Nickel price is going off the charts. Copper price is going off the charts. So this leads to out of control inflation. So the CPI data came in last week, I believe, and it was somewhere like 8%. So it's absolutely going nuts. There's also the risk of escalation of the war situation between Russia and Ukraine. That's just really sad situation over there. But there's also a possible escalation in the tension between U.S. and China. So there's also the Fed tightening issue and supply chain crisis. So there's definitely a lot of fear in the market right now. So let's go over the data that's pointing to this possible recession. So one of the first thing I want to look at over here is the VIX, right? The VIX is commonly known as the fear index. But what it is actually is a measure of how many put options are being purchased at the moment. How much, in a sense, how much protection are people, uh, how many protection, how many people are buying protection for potential downside risk. So you can see over here that this was the spike during the first COVID wave. So a lot of people were had a lot of fear, so they bought a lot of puts. Usually when it's this high is generally a time to buy, right? So that's relatively high. So after that, it kind of came down, and it's been on a downtrend ever since then, right? If you look at the 9 and the 20 EMA, right, the 9 and 20 EMA, if I draw a line, it's been on a clear downtrend. So over here, times are good. When the VIX is usually low like this, everyone's happy. You have all these stupid YouTube videos saying 10x stock, 20x stock, 100x stock. You don't see those around anymore, right? And the reason why is because you can see there's this accumulation of fear. Do you see this ascending triangle? So, you know, there's a general belief that if around the 30s or so, it could be a good time to purchase stock because be greedy when others are fearful. But in this case, that might not be the case, right? Because if you look at it, it's only at around these levels over here. So it hasn't broke above this level yet. So we might not have reached peak fear, basically. Based on this ascending triangle, it could definitely push past this. So, based on the VIX, there's definitely a possible recession, right? There's definitely, I wouldn't say we're at max fear at the moment. And if you look at another index that I like to use, this is less commonly used. Not many people talk about it, but it's the Skew Index, right? The Skew Index is kind of the same thing. Is a measure of how many put options there is in the market. So if it's around 100, that means there's a lot of put options at the money. And if it's close to 150, that means there is a lot of put options out of the money. So it's a little counterintuitive. This one is kind of like the inverse of the VIX. Like the higher the number is, the closer it is to the 150 mark, is actually more bullish because people are only buying put options further out in the money just in case of a black swan event. So as it gets closer to 100, that is people buying put options at the money. So this means that they're expecting in the short term that the market is going to go down, and you can see clearly over here it's going on a downtrend. So it's heading towards that 100 level, which is here. And you can see around 2020, during the peak COVID situation, it was at around 114 around here. So, you know, I think you have to look at this more like how the trend is being developed, and it's definitely trending down. So the skew index is also pointing to a possible recession. Another one is over here is the yield curve. So the yield curve, I think, every once in a while there's this inverted yield curve that pops up in the news cycle, right? But what exactly does that mean? So this is when you see longer term yield. So here you see the 30 year yield. This is the 10 over here, and this is the 2. So a healthy yield curve is something like this, right? So kind of something you saw last year, which you saw over here in 2021, is where there's a large difference between the 10-year and the 1 and the 2. So that's a healthy yield curve because there's no near-term risk, so they give you very, very small yield, very small return. And further out you go, there's more risk because less predictable, they give you a higher yield. But this is telling you right here that potentially near term there's a lot of risk, the same amount of risk as the further out long term. So that's definitely not a good sign over there. So basically it's telling you near term there's a lot of risk. So it's kind of a risk off environment right now. So when you get an inverted yield is where you get like the near term yield is actually above the further term 30 year or 10 year 20 years yield. So this is definitely pointing towards either a recession or a deflation, or both. So the difference between deflation and recession is that deflation is actually an increase in supply that can drive that. So that's a possibility. And recession is basically a contraction of economic activity. So they could happen both at the same time. But deflation can also happen because of just lack of demand. So that is basically economic contraction as well. So it's not necessarily a good thing to have deflation, depending how you get it. If you get it by increased supply, that's a good thing. But I think in this case, I'm leaning towards more a recession more than deflation. Just my personal opinion. I know there's a lot of people out there that think that we are going to head into increased supply deflation. So another indicator that pointing towards a recession is the oil price. So the oil price has been a very good indicator of recession. It has predicted almost all the recession recently. The 2008, the 2000. You can see it right clearly over here. And now the oil price is popping to this very, very high level again. So this is oil price pointing to a possible recession. Let's look at the SPY chart, just some technical analysis right now. So if I go over here, I'm going to go straight to my platform, Dash Trader Pro. So if I go over here, I bring out the SPY. So I mean, the first thing you notice is what the technical people call a def cross. A def cross is basically a clear indication of a reversal of a long-term, long trend reversal. You see it right here is where the 50 moving average and the 200 moving average on the daily crosses. right? That's why they call it the death cross. So you see this clear uptrend of these two, the 50 and the 200, and now you see clearly the 50 is starting to curl down, and now it's passing below the 200. And if you also look at it, you can also see there's kind of like a head and shoulder that form, right? There's the left shoulder right here, that's the head, that's the right shoulder, and this is kind of like the neckline. So it kind of broke below that. So there might be a bounce off this level, off this 410 level, maybe a dead cat bounce. But if things don't go well, it could definitely continue going down. So yeah, so that's also a possible recession, right? Based on the chart, is a possible recession as well. So there's a big meeting. I think it's tomorrow, March 16th, where they'll decide on the Fed rate hike. And just as a general information, normally when the Fed increase rate as expected, it could actually mean bullish for the S&P 500, because this means that things are going as planned. The market really hates uncertainty. So if the Fed decides to do some kind of fast rate hike and surprise the market, I mean at that point I think it'll be 100% recession. If it actually does that, that will be a very big signal over there. The big meeting is actually this week. If I bring it out over here, yeah. So you see over here, March 16, 2022, and there's a 99% chance almost that the rate hike will be between 25 a quarter to 50 basis point. So if things stay within this range, that's actually a good thing, and you might see potentially bottoming effect, especially if the geopolitical situation improve. It might be starting to be forming a bottom. But if it does something like a 75% basis point hike, or even a 0% basis hike, if there's anything that is not 25% basis point hike, you can expect a vicious drop in the market. But that's for the rate hike. So basically, based on all the data that we have, there is almost 100% risk of some kind of economic slowdown, some kind of deflationary pressure in the market, and I would say an above average risk of a recession. However, if the Fed do kind of a slow cycle rate hike and the geopolitical situation kind of improves, we might see a rebound. Like, I'm not going to rule that out, right? I know there's a lot of video out there that only tells you about recession, and basically they're doing that for war, they're doing that for views. But I'm going to present to you, well, the reality. The reality is that there could be a rebound. If the Fed, they don't do something drastic. Jerome Powell doesn't seem to be the type of guy that likes to shock the market. He does things pretty standard. So if he does that and somehow the geopolitical situation improve, we might see a rebound. And it could be some kind of sick scenario where this economic slowdown helps ease the supply chain and inflation pressure, because we might get deflation, right? So we have an inflation problem. So maybe a little deflation is good for the market. So this allows the Fed to keep the rate hike very steady at a smooth pace, and the market goes back to the moon. So you never know. So this is the situation. This is what all the data is telling us. That there is a risk of a recession, but don't be surprised if the market rebound at the same time. But so what's the trading plan? What's the trading plan for short term for my short term plan, right? My short term plan is actually to find weakness in the consumer discretionary sector. So this is your Starbucks, right? So if the gas price so high, I don't see anybody spending $5 on a coffee. Well, there'll be less people, let's say. The Peloton of this world, like $2,000 machines, like these kind of spending, these kind of discretionary spendings, this market I think would get hurt in the near term, and that's the trading plan that I have for this. And just a small word on probably for long-term investor. Like I have some long-term holdings as well. You know, uh, just stay calm, right? Like there's a lot of studies out there that shows that the long term, I'm talking about like, 5, 10, 20 years out, the correlation between the return on the S&P 500 versus the return, the earning growth and dividend yields, there's a strong correlation. So as long as there's earning growth in the companies and the companies are paying out dividend yields, that's you'll do fine. In times like this, it's very important to have companies that are very strong in earnings, strong balance sheet companies, and you'll be fine over the long term. Like I don't know specifically which stock is going to do better than the other. Personally, I own a lot of Tesla stock, but any stock that has good future growth and good earning growth, and even if they pay a dividend, that's an extra, right? So that's it. So I just want to show really all the warning signs out there that can potentially lead to a recession. And I'm not gonna lie, is definitely a higher risk right now than it was, I would say, even a few weeks back. So, if you're a trader, trade safe out there. If you're a long-term investor, stay calm. Stay calm. So take care, guys. And if you guys like these kind of videos, please consider liking and subscribing. See you guys next time. Bye.